The 3rd of September 1929, the Dow Jones Industrial Average closes at 381.17, which was an all-time high that felt like the peak of a mountain that would never end. Newspapers at the time were running headlines saying America had entered a permanent age of prosperity, a phrase that sounds hauntingly familiar to anyone paying attention to the news cycles of today. Margin debt had climbed to roughly 8% of national output, which was the highest level ever recorded at that specific point in human history. Corporate insiders were quietly cashing out their positions while the general public was still rushing into the foyer. Industrial production had already been falling for 2 months, yet nobody in that exact moment believed anything was wrong because the price on the screen was still green. May 7th, 2026, the S&P 500 closes at 7337, a record that makes the gains of the past decade look like a warm-up act. The Shiller cyclically adjusted price-to-earnings ratio sits near 41, which is the highest reading in history outside of the madness of the dot-com bubble peak. FINRA margin debt has just hit $1.28 trillion, an all-time high in absolute terms that signals a level of borrowed conviction that should make any sane person pause their coffee mid-sip. The corporate insider buy-to-sell ratio has cratered to 0.24, meaning company executives who actually know the books are selling 4 shares for every single one they buy. These are not 2 different photographs. They are the same photograph, just taken with a higher resolution camera and a different date stamped in the corner. I am Dave Schwab, and on this channel we read markets through the lens of historical pattern, not the noisy headline sentiment that exists to keep you clicking and keep you poor. Today we are walking through 3 specific things that will determine whether you keep your wealth or hand it over to the professionals. First, we will examine what stage 5 of a market cycle actually is, and why every major peak in modern history has gone through this exact sequence of terminal euphoria. Second, we will look at how the 1929 crash actually unfolded month by month, because the speed of it is the part most people get completely wrong, expecting a sudden drop when it is actually a slow bleed. Third, we will identify where today's market sits on that historical template, and what a regular investor can practically do about it without needing a PhD or a heart monitor. None of this is financial advice, because if you need a stranger on the internet to tell you exactly what to do with your life, you have already lost. This is education for the clear-headed. Let us go. Markets do not crash in random moments of bad luck. They crash at the end of a 5-stage cycle that has rhymed across 2 centuries of human greed and fear. Stage 1 is the slow climb out of the previous wreckage, where nobody believes in stocks and the memory of the last crash is still a fresh wound. After the 2008 crash, that was the year 2009 when Warren Buffett famously wrote his Buy American op-ed, and most people thought he was an old man who had finally lost his marbles. Stage 2 is acceleration, where new technology shows up and pulls real capital in because the growth is actually tangible and exciting. Cloud computing and software as a service did this from 2011 through 2016, creating real value and real millionaires. Stage 3 is the mid-cycle wobble, where something genuinely scary happens that makes the weak hands fold. The market drops fast and recovers fast, and the COVID crash of March 2020 was a textbook Stage 3 event that cleared the decks for the next run. Stage 4 is broad participation, where the general public re-enters the arena with a vengeance. This is when your friends start asking you about stocks at dinner, when crypto gets discussed at family weddings by uncles who do not know what a blockchain is, and when index fund inflows explode because people think it is free money. This is roughly where we lived through 2023, 2024, and most of 2025. Stage 5 is the blow-off top. And here's the one thing you have to understand if you want to keep your sanity. Stage 5 does not mean the market crashes tomorrow morning. It means the foundation underneath the price has already cracked and the structure is held up by nothing but momentum and prayer. The price is still rising on belief, on borrowed money, and on the stubborn conviction that what worked for the last 3 years has to keep working forever. But the underlying earnings, the productivity, and the real economy have already started to weaken under the weight of their own expectations. That gap between what the price is doing and what reality is doing is the signature of Stage 5. In every major historical top, 1873, 1929, 1966, the year 2000, and the year 2007. The same pattern shows up like a recurring nightmare. Valuations stop making sense, leverage hits an extreme that cannot be sustained. Insiders sell their stakes, and the real economy turns south. And then somewhere between 8 and 18 months later, the price finally catches up to what was already true on the ground. That is also where the smartest investors get their reputation for being geniuses. They see the divergence early and they start playing defense while everyone else is still partying. They look early, which often means they look wrong for a while, but then they look right for a decade while the crowd is busy filing for bankruptcy. The financial press loves to celebrate these investors after the fact and quietly forget all the people who screamed for them to stay invested at the top. The applause always arrives late, usually when there is no money left to cheer with. Most people have a wildly wrong mental model of 1929 because they watched a 5-minute documentary once. They picture one bad day, Black Tuesday, with brokers jumping out of windows and the world ending by dinner time, it did not happen that way at all. The crash unfolded across 33 months in measurable stages, and most of the wealth was destroyed slowly through forced selling and the agonizing unwinding of leverage. Here is the actual timeline that they do not teach you in school. September 1929, the Dow hits its all-time high of 381 and sentiment is purely euphoric. Margin debt is at a record and stage 5 is officially in motion. October 1929, the first major drop occurs with Black Thursday and Black Tuesday. And forced liquidations begin as the brokers call in their chips. The Dow loses about 25% in a single week, which is a shock, but not the end. November and December 1929, the market actually rallies and the bounce is strong. Newspapers declare the worst is over and officials tell everyone to buy the dip. Retail investors who had been waiting on the sidelines saw this as their golden opportunity, and this is exactly where they bought in. This is where most of them got trapped because the bounce sucked them back in before the real damage even started. The whole year 1930, the market grinds lower with no single dramatic day to point to, just a slow and steady erosion of capital banks. Start failing. Industrial production collapses and unemployment begins its long climb. By March 1931, roughly 18 months after the peak, the Dow has lost about 58% from its high. But the real bottom does not come for another full year. The actual low is reached in July 1932. The final damage from peak to trough is 89%. Read that number again and let it sit in your stomach, 89%. A $10,000 portfolio became $1,100. And the people who lost the most were the people on margin, because by the time the broker called them, their equity was already gone and the forced selling had begun. Here is the lesson hidden inside that timeline. Crashes do not destroy wealth on day one. They destroy it through time, through leverage, and through the false rallies that pull in anybody still holding on to hope. Now we map the 4 classic stage 5 signals onto the tape we see today. In 2026, signal 1, valuation has detached from earnings to a degree that defies logic. In 1929, the Dow price-to-earnings ratio hit roughly 33, which was an all-time high at the time. Today, the Shiller cyclically adjusted price-to-earnings ratio on the S&P 500 sits near 41. That is higher than 1929 and only just below the absolute peak of the dot-com bubble. The historical median going back to the 1800s is 16, so we are running at roughly 2.5 times the long-term normal. This does not mean a crash starts on Monday morning, but every single time the market has lived above 40 on this measure, the next decade of returns has been weak or negative. That is not a forecast, that is just recorded history showing us the bill eventually comes due. Signal 2. Leverage is at extreme levels that create a fragile system. FINRA reported margin debt of $1.28 trillion to start 2026, which is the all-time high in dollar terms. As a share of national output, it sits at roughly 4%, and while that is below the 8% estimate from 1929, it is still more than double the long-term median of 1.5% margin. Debt grew nearly 39% in a single year, which shows a desperate rush to juice returns. Now here is what the simple 1929 comparison misses. Modern leverage is not just margin loans anymore, it now lives in zero-day options, in corporate buybacks funded with debt, in private credit lines, and in complex carry trades built on interest rate differentials around the world. The total leverage in the system is far larger than the FINRA number alone shows. So anyone telling you this time is different because we are less leveraged is quietly hoping you do not look at the broader picture of shadow banking signal 3. Insiders are running for the exits while the public buys the marketing. In March 2026, the corporate insider buy-to-sell ratio fell to 0.24. In January, the inverse ratio of sells to buys hit 4.83, which was the most extreme reading since the frenzy of 2021. The people who actually run these companies, the executives and directors with privileged access to balance sheets and order pipelines, are quietly trimming their personal stakes at a level we have not seen in years. Retail flows into equity ETFs, by contrast, just hit record highs as people chase the performance of the last 12 months. One side has the information and the other side has the enthusiasm. History tells you which side is usually left holding the bag. Signal 4, the biggest tell of all, is the behavior of Berkshire Hathaway. As of the first quarter of 2026, Berkshire is holding $397 billion in cash and short-term treasury bills. That is the largest corporate cash position in the history of American business. Cash is now over 30% of Berkshire total assets, which is the highest proportion in 3 decades. Warren Buffett, who built his career on the line of being greedy when others are fearful, has spent the last 12 quarters quietly being the opposite of greedy. He stepped down as CEO at the end of 2025 and handed Greg Abel that war chest to deploy when the time is right. You can disagree with Buffett, but disagreeing with the most successful investor of the modern era on the specific question of whether this market is expensive is a position that carries a fairly heavy burden of proof. Here's what Stage 5 actually means for a regular investor who is not a hedge fund or a billionaire. First, stop trying to time the exact peak like it is a video game. If pattern recognition tells us anything, the gap between when the warning bell rings and when the price actually breaks can run anywhere from 8 to 18 months. selling everything and sitting in cash for a full year, while the market keeps grinding higher, is a real way to underperform and feel like an idiot. Buffett, with his record cash pile, still owns roughly $250 billion worth of stocks. Defensive does not mean absent, it means being prepared for the weather to change. Second, reduce concentration in your most expensive positions. If a single stock or a specific theme has run up so much that it is now 30 or 40% of your portfolio, the risk math is no longer balanced in your favor. Trimming it back to a normal weight is not being bearish, it is just basic financial hygiene. The companies you bought are still good companies, but the price is the part that has changed. And price is what determines your future return. Third, hold actual cash, not just a promise of a credit line. Real cash in money market funds and short treasury bills are paying real yields right now, so the opportunity cost is low. Having 6 to 12 months of expenses in liquid form is not a missed opportunity. It is the thing that lets you buy when everyone else is forced to sell at a discount. The investors who get rich after a crash are the ones who had cash on the day the panic started, not the ones who tried to borrow it later. Fourth, avoid leverage. You do not absolutely need margin loans, levered ETFs, and options bought to chase momentum are the tools of the desperate in a stage 5 environment. These are exactly the instruments that turn a normal 30% drawdown into a permanent wipeout of your net worth. The forced selling cycle of 1930 was triggered by these exact structures. The names of the products have changed, but the mechanism of the margin call has not changed one bit. Fifth, have a written plan for what you will buy and at what level when prices are lower. The hardest part of investing is not what you do at the top when everything feels great. It is what you do at the bottom when everything feels like it is falling apart. The investors who buy stocks during a panic make life-changing returns that last for generations. The investors who freeze because they are scared make none. Putting that plan on paper today when your head is clear and your coffee is warm is the single most useful thing you can do for your future self this year. Stage 5 does not mean you should run for the hills and live in a cave. It means you need to be honest about where you are in the cycle. The market is at a record. Valuations are at the highest end of any data set we have available. Insiders are selling their shares. Leverage is at an all-time high across the system. The successor to the greatest investor of all time is sitting on the largest cash pile in corporate history. The real economy is starting to soften around the edges. Every one of those things is a verifiable fact that you can look up yourself. None of them is a prediction of the future. But when all 5 of those signals line up on the same calendar page, history tells us that the asymmetry of risk has shifted against you. A defensive posture stops being an optional strategy and becomes a mathematically rational necessity. Whether the actual peak prints in late 2026 and 2027 or somewhere different again, the playbook for survival does not change. Reduce your leverage, hold your cash, and avoid extreme concentration. Plan your buys for the discount, not your exits at the top. The 18-month clock from September 1929 ran out in March 1931. The clock is ticking now too, even if you choose not to hear it. The question is not whether you can predict the peak with perfect accuracy. The question is whether your portfolio and your lifestyle can survive being wrong about where that peak actually is. I am Dave Schwab. This is The Real Investor. I will see you in the next one.